Welcome, everybody. It should be afternoon for almost everyone, apart from Mark, where it's early morning. But good morning, good afternoon, everyone. Welcome to this WAPPP webinar that's hosted by the Africa and the Ports chapters today. My name is Prima Atugonza. I am the chair of the Africa WAPPP chapter, and I'm honored to be your moderator today. Our webinar today is going to explore the theme of concessioning out management and operations of existing ports and terminals in Africa to the private sector and to private sector operators and investors. We have a very good panel set out today, but before I introduce them, I'll just jump in a little bit and say a little bit about WAPPP for all those that may not be too comfortable with who we are. WAPPP is the World Association of PPP Units and Professionals. It's a global network of the PPP units and professionals and is based out of Geneva. WAPPP is a global independent NGO and serves the PPP profession by promoting international best practices, and it helps to achieve the UN SDGs. At WAPPP, we'd like to say that we network, we engage, we inform, and we advocate. We are structured into regional, sectoral, and thematic chapters that will just help you to understand a little bit about how today's webinar is structured. The regional chapters, just like they are based out of different regions. So we have the Africa region that I chair, we have North Africa, we have Latin America, we have Europe, Africa, etc. And the members of WAPPP in these regions meet to discuss region-specific issues. Since PPPs also cut across different sectors, we also have sectoral chapters. So that's healthcare, water, airports, ports, that brings us here today. And we have thematic chapters, especially for practitioners like the legal chapter, the financial chapter, academic, people first, etc. Today's webinar is hosted by Africa and Ports chapters, and I will therefore be co-moderating this with Mr. Eric Ville, who is the chair of the WAPPP Ports chapter. And he's a very senior sector expert who has been in the port space since 2001. Eric, please say hi.
Yes, hello, everybody. Thank you for the presentation, Prima.
Thank you, Eric. I'm going to introduce the panelists now. Our very first panelist is Mr. Mark Ewell. He is an independent consultant in the transport sector, infrastructure and services as well. He has a particular interest in ports and shipping. Mark retired from the World Bank in 2014, which he had previously joined in 1992 as a port specialist. From 2007, he held the position of sector manager transport. And before this, he had previously spent 11 years with a French consulting group. First as a project manager, then as a director of the Ports and Inland Waterways Department. In this capacity, he managed port and maritime development projects in about 25 countries. We're therefore in good hands. Mark is a sector veteran, and I'm sure he'll have a lot to say today. Mark, say hi.
Hi, everybody. That's great to be here. I hope we'll have a very fruitful and challenging discussion. Thanks, Prama.
Thank you very much, Mark. Our second panelist is Mr. Ahmed Mohamed Mohamud. He's the general manager of the Mogadishu Ports Authority. Ahmed has over 38 years of professional experience and has worked as a consultant with multiple donors and agencies like the EU and the ICRC. So he's acquired skills in project identification, formulation, and implementation. At the Mogadishu Ports Authority specifically, Ahmed, who I have worked with very closely, initiated a series of internal processes, including the review of the port concession agreement between the federal government of Somalia and the port operator. He also received legal support from the Africa Legal Support Facility and technical and commercial support from the World Bank and the EU. Welcome, Ahmed. We're looking forward to hearing from your in-depth experience. Ahmed, we can't see you, but you can say hi.
Hi, everybody. Thanks for the short presentation. Thank you. For the short introduction. Thank you.
Thank you very much, Ahmed. Our last, should not be last, but our other panelist is Sib Rui. Sib, you'll have to correct how I said that. But Sib is the head of Business Development Africa for APM Terminals. He has been with APM Terminal since 2013, but since 2018, he has been leading the business development activities. He's also head for portfolio optimization in Africa and Middle East. Prior to this, he was a projects lawyer in M&A and PPP matters at Freshfields in Amsterdam. Sib will today definitely present the private sector experience and operations. Say hi, Sib.
Thank you. Good afternoon, everybody. My name is Sib Ruig, for those able to pronounce the Dutch pronunciation. But looking forward to an interesting discussion. Thank you, Brian.
Thank you very much, Sib. And we have been joined by Mr. Richard Ibwima. Richard is an executive with the Namibian Ports Authority, and he currently leads the business development function of the port concession for Namibian Ports Authority, also known as NAMPORT. Richard is highly experienced in port and terminal logistics strategic management. Welcome, Richard.
Thank you. Welcome, everyone.
Excellent. So welcome, gentlemen. We're looking forward to learning from all of you today. Even as we get into it, I'd just like to welcome everybody that's logged in and also encourage you to participate. Please notice that there are chat functions, the usual Zoom chat functions. I'm sure we're now all Zoom experts. There's a Q&A where you can post your questions, but you can also post general comments that I will read out even as the discussion is ongoing, so that it's easy for us to engage. We will have a Q&A session at the end, but we're also open to having questions that are very relevant to something that's up for discussion, even as the session is ongoing. So I think I've spoken enough. I will hand over to Eric. Eric is going to set the stage. Just let us know why this discussion is very important, what we're talking about today, and then we will jump right into it with the panel. Over to you, Eric.
Thank you very much, Frida. I'll just try to share my screen. Just give me a second. Can you see it now?
Yes.
Super, wonderful.
Yes, we can see it.
Very good. Yes, I'll try to set the scene and do a very brief introduction to the topic. We have over the last couple of decades see an increased private sector involvement in port operations, and I have a slide here in front of me which are sort of showing a classification of ports, and we are using the World Bank categorization here in this case. If you start from we have a column structure where we have we can see different involvements of the private and the public partner, and at the very top we have a public service port, where it's basically the port authority operating and managing the port and providing basic port services, marine services, and making all the investments. The column to the left are sort of basically infrastructure. The superstructure is meant to be everything you can say on top of as above ground, being equipment investments, investments in buildings, IT, and so forth. The management operations are basically the cargo operations, and other functions are typically marine services. Could be pilotage or security, servicing the vessel, like the water and the garbs and so forth. A tool port is a port where you have a limited private sector involvement. It could be sort of a shipping line operating, stevedoring, performing yard operations, or it could be a freight forwarder. The investments from the private side are quite limited or none, and all functions are mainly done by the port authority. The landlord port is sort of the new industry standard, and it's a proven and tested institutional framework where the port authority is sort of the custodian for the land and the infrastructure and also providing port services like pilotage or traffic monitoring the port, whereas the private part is investing in superstructure and other infrastructure, and is basically managing and operating the ports. And in some places we have also seen a few instances where the private partner is performing all the functions in the port. It's only a few places in the world, mainly in the United Kingdom and a few other projects around the world. And I think that the main reason is that the public side would like the public side consider port investment as a key infrastructure of national interest. So the public side is naturally reluctant to give up interest in that. And today we'll sort of discuss the transition from a public service port to a landlord port, and what steps are required and what is needed for that. And as part of that, also a number of analysis has to be done, and we refer typically to the public service port as the public sector comparator. So when the public side, whether being the PPP unit or the port authority, is performing the financial analysis, the reference point would then be the service port. And doing the process here, it's very important from the public side that that you define a number of steps starting out, and it's important that the public side sort of define the key objectives. One would naturally be that the port performance is of pivotal importance, and in order to improve the supply chain and have an effective and resilient supply chain. But there can also be other reasons. And another question is what sort of studies needs to be put in place, whether you need to do a full feasibility study, whether you need to do market sounding and so forth. And often this is sort of untested land. So and this may be sort of the first privatization project in a country. So important question is also who can help the port authority or the other or another government agency during the process. And today we have Mark on the panel, and he would likely be able to shed some light on that, what like development banks can offer in this regard. Another question would be about regulation, where the legislation regulatory framework is in place already, like PPP laws and concession laws, or whether that need to be strengthened. An area typically which needs to be looked into would be the regulation of the port authority, because part of the process would be to sort of assess which task the port authority would continue to do and which one would be shifted to the private party. Another big topic would be labor reforms, as for public ports, staff are normally civil servants, and often we need to implement new methods there and new ways of hiring people. It could be contract labor. Another key element would be sort of a suitable risk allocation between the public and private party in order to focus on improving the value for money and optimize the value for money for the procurer, and also improve the bankability of the project. Part of the process would be to choose the right concessionaire, and also important would be to have an effective and transparent procurement process. Finally, when we shift into implementation and monitoring during the concession period, it's important to monitor the performance over the concession period. So those would be sort of key areas which we'll discuss today, and we have both the private sector perspective and the public sector perspective, presented here, and also the advisor as well. And our cases are from Sub-Saharan Africa, but all these points are equally important for other parts and regions of the world. One of the reasons why we have chosen and prioritized Africa here is right now we are seeing a number of projects now being put out in concession. Namibia is one place, but also the Gambia and is another place. And in Sub-Saharan Africa, or in South Africa also, they have taken steps of dividing the operating entity of Transnet and the infrastructure net separate nets. So I hope that sort of could sort of set the scene, and I'll hand back to you, Prima.
Thank you very much, Eric, for helping us to set the scene about the discussion today. As you talk about the public sector, it's very interesting. I've seen a couple of participants from the public sector. I've seen representatives from the PPP unit of the government of the Gambia. I've seen representatives from the PPP unit in Namibia. I've seen people from Mogadishu Ports Authority. So we are amongst friends. And right now, even as we jump into it, I'd like to start with the public sector. Richard and Ahmed, we'll start with you, Richard. When we are talking about concessioning out of ports management, what are the objectives of the government when it chooses to take this path? What are you looking for? What are you looking for? Who are you looking for? Please go ahead, Richard, give us a brief of your ports and what's happening at NAM Port, and generally what the why of why different governments, at least why Namibia is looking or has looked to concession out management. Over to you, Richard.
Thank you, Prima, for setting the scene, and Eric as well. In terms of the case for Namibia for concessioning, I think what we looked at was more a few things. From an economic point of view, we invested in a facility which was the biggest investment, if I can call it that, for the Republic of Namibia in terms of public sector investment. And also, after doing that, after doing the investment, what we've done is just a background. What we've done is that before we invested into the current new container terminal that we are on currently busy concessioning, is that we did a study. We did several studies. Actually, there was a study that was commissioned, I can remember, that was commissioned by JICA. There was a study that was commissioned by the Hamburg Port Consulting in Germany. And the World Bank, I think Mark will know that they helped us a lot also in doing several of these studies. And once the terminal was built, eventually our aim was to concession, because background, if you look at Namibia, we are a very small population. Captive market is not one of those strong points that we have economically. We are a population of 2.5 million people. In 2.5 million people, there are a few consumers, especially for port-related products. So we built the facility, and after building the facility, the first step that we did together with the World Bank, we commissioned a study. I think it was way back, if I'm not mistaken, way back in, before we even built the terminal, after we built the terminal, way back in 2019, we commissioned the study. A sort of expression of interest, looking at what the interest for investing in a terminal in Namibia was. That study was not very positive, and we were advised by the World Bank not to follow the concessioning route. The other thing is that we were also looking at, currently, as Eric, said earlier, the entire port, marine, terminal environment or industry is going into the landlord model of port management. And we thought as the Namibian Ports Authority also we should explore this landlord model where the whole world was going into. Secondly, if you look at the investment that we put in, it was going to be very difficult for us to look at or to find the resources to invest further in the terminal. For example, we've got something that is very big, especially for the Port of Walvis Bay, which is our channel, to dredge the channel and then to make sure that you bring in bigger ships to the facility. So in short, that is what motivated the case for concessioning. And also, again, as I said, as a last point, volume. For any terminal, container terminal, you need capacity in terms of volume. And the only way that a country like ours with the population that we have can actually optimize a facility like this is to look at transshipment. And yeah, those were the few points, I'll elaborate later, that made the case for concessioning in the case of Walvis Bay.
Thank you very much, Richard. So Namibia was looking at volumes, also looking at the number of consumers in country. Ahmed, what was the government of Somalia looking for? Over to you, Ahmed.
Thank you, Brima. In Somalia is a unique case. First of all, the government at the time was just financially very weak position and could not access international financial markets because of debt issues. So it was a natural option to outsource the port management and investment. But the main objective was first to remove the operation from the public sector inefficiency. That was one of the objectives of the port, but also to secure investment capacity, an operator that has the investment capacity, but also to ensure that the government revenue stream is continuous without interruption. But also government has also other operation has to be run according to international standard. There has to be clarity of contractual performance, that both sides know what they want to do it. So for us was purely to secure investment, but also to secure the government revenue stream. Government is much dependent on the port revenue, as you may know, in Somalia. But also the port authorities were inefficient at the time. And because the port was reoperated after the civil war, there was nothing there for equipment to handle even any cargo. So we were in a very unique situation. And there was no also other operators that interest. So the only operator we had was the one we have now, and the government signed the concession agreement at the time in 2014. So I will elaborate later on which processes that we want and what are the challenges.
Thank you very much, Ahmed. So we have a bit of an idea, not everything, but we have a bit of an idea of why governments choose this. So many times it's a financial consideration. Sometimes it is to always leverage on the private sector. And now that we sort of know a bit of the why, I'm going to move to Mark to just tell us the how of port concessions. Mark, just from your years of experience, how should this be done properly? What sort of studies should be done? What should the government be thinking about at the point that it chooses to leverage private sector investment? Before it just quickly jumps into something like that, what is the how of concessioning out of ports? Where should governments start, and how should they steadily move through the process? Over to you, Mark.
Thanks, Prema. Yes, well, actually, Richard and Hamid highlighted a few important things when the government is considering concessioning a facility, either to get it built and operated or just to concession an already existing piece of infrastructure. Clearly, the main thing that was hinted at already is to have clear objectives about what you are doing that. And clearly, find additional financing or off-budget financing could be one, but it would be dangerous just to consider concessioning as a way to just put this kind of investment off the budget of the country, because it will come back to bite you at some point. The government needs to have a very clear understanding and a clear objective to what it wants to achieve. And clearly, as in Namibia, government needs a new piece of infrastructure. That's what the need of the country. It's difficult to finance because it's costly. And on top of that, on top of the additional financing, many governments would like to avail themselves of the additional professional capacity of an operator, which will help train and grow up the national workforce, and also could bring some innovation into the process. And that's what we have been seeing. We are coming at a point where a number of the first wave, I would say, concession of the 90s have been or are being renegotiated now. And so there are a lot of lessons which have been learned and that have been factored in the process. In the early concessioning process that we have been witnessing in the bank and together with other international donors, there was a bit of a rush to get this financial capacity which seemed to be there. But at the same time, often there were kind of confusion of what objectives are we pursuing exactly. I mean, Richard was clear enough on what objectives the government was looking for. In some cases, it was a little more murky. Obviously, there is a thing to say, okay, I would like to get some additional money to get this piece of infrastructure, or I would like to get a better productivity so that I can bring down the cost of transiting through the port. Or sometimes it was just, well, I need some more money into the government treasury, so that's one way to get it. Well, you have to know what you want. And clearly, in the last case may not be the most fruitful. Also, some country will tell us, look, guys, I mean, we have very scarce resources. We believe that's a way to get more resources with which we could invest further. And then the answer would be fine, but just make sure that you understand the consequences of having a port which is more expensive, because all of your citizens basically at some point will bear the brunt of this consequence. So clear objectives, knowing what you want to do. And of course, there are a number of additional studies which are being done in terms of marketability of the thing, in terms of what actually the private sector can be expected to finance. There have been some dreams about what the private sector could do, and I believe we have come back to realizing that there must be a field of reality there, a reality check at some point. But most of the time, and that was the case in a number of projects the bank was involved in, there is a natural sharing between what the public sector should invest on and what the private sector would be willing to consider. For instance, accesses, protection, typically that's the kind of infrastructure that the public sector will have to invest in. One of the latest bank operation I was in when I was still in the bank was in a country where a significant protection had to be built, a big breakwater, to make it possible for the private sector to invest behind it. And that's what happened. We had a contract basically whereby the bank lent money to government to build the breakwater, but at the same time, we had a concessioning operation going on to make it possible for a private investor to come in and actually build the quays and operate them. The quays protected behind the breakwater. It's kind of typical sharing of responsibilities between the public and private sector. And this clear clarity of objective in one thing, and of course you need a clear legal framework. Today, more often than ever, the money is a lot of money is available. Actually, the question is to find the right framework for this money to get invested in. And indeed, a PPP framework is most often necessary. Now, there are two different kinds of things. You can have a perfect PPP law in place, which is the ideal case, everything in there. So the law, the regulation, the regulatory framework is well defined in the law. In most places, and the way things happened in the past and still happening today, sometimes it's not yet there. You can have the regulation embedded in the national law. You can have also, and that's the case in many places, regulation by contract, meaning the regulation is embedded in the contract. Now, that doesn't solve all problems. It's assumed that the public counterpart will be trained and will be, let's say, will have will be equipped to handle this kind of relationships. So typically, with the first wave of negotiation of concession, a number of concessions were actually built this way, with the regulation embedded in the contract, but with a big asymmetry when it came to negotiating this concession between the government, which would not use in most cases to deal with this kind of contract, and the private sector, which was very well equipped with all lawyers needed to make sure that the contract was actually tailored more to their needs sometimes than to the needs of the government. And there needs to be a meeting of minds and meeting of needs here for this to work on the long run. So today, I would say, with all the insight we can have, it's obviously preferable to have a clear legal framework in place, which will put in place the ground rules, which the new concessions contract will be referring to. In South Africa, for instance, there is a national port sector law. There is a port regulatory authority created at the national level, so that the concessions which are negotiated can refer to these basic ground rules, basically, and have the specifics of the regulatory details embedded in the contract. And that's quite necessary to make sure that you can actually attract significant interest and sometimes significant investment for the private sector. When we are locking somebody in for 20 years or 30 years, people who are coming want to make sure they will operate within a reliable, stable legal framework. And there are ways in which the bank can help, but I suppose I will stop here at the first stage and we'll get back to that later. Thanks.
Thank you very much, Mark. I think we're all speaking the same language. The objectives must be clear. What the government is looking for must be extremely clear. There must be some kind of framework, not always the PPP law in place, but there must be a framework that's favorable for a private investor to operate. At this point, we're going to jump to the private sector. Sibe, please just elaborate on what the private sector is looking for when it's looking to partner with a government agency for such concessions. What do you consider? What do you look at? Who do you choose as the right partner when you choose to get into this sort of relationship with the government? Over to you, Sibe.
Thank you very much. Indeed, as already alluded to in quite some detail by Mark, what we as private investors in concessions are basically looking for is we want to be able to generate a decent return, right? Of course, we want to have the ability and the rights to actually bring the expertise and do best what we think that we do best, which is controlling the operations and actually adding value to our customers and basically simplifying the supply chain in the country. And it is about that framework that is being created in a concession agreement that determines whether those objectives can actually be achieved. So what we need in order to achieve that is basically having clarity on the obligations of us as a private operator, but also of the public partner in this sense, right? So you have, as already alluded to by Mark, typically in a landlord concessionaire model, you have a split responsibility for construction and maintenance of certain parts of the facility that are done by the public partner and that are done by the private partner. The concession agreement basically needs to be very clear about what that exactly entails. What are the current and future investment obligations of us as a private operator, right? We are getting into that relationship and partnership for a period of 20 to 25 years. So we would need to know how much would we need to invest and what are the triggers for that. And then preferably, those triggers also need to make some economic sense. For instance, having just an investment obligation to add another 4 STS cranes by the pure lapse of time isn't typically something that is very attractive for us, right? If the market isn't there and we are actually able to run the operations with the existing equipment on site, then automatic investment triggers would be something that are not attractive from a private perspective. When we talk about maintenance obligations, same thing. You need to have a decent replacement and maintenance schedule for your equipment, and not be obliged to replace certain equipment after 10 years if the normal depreciation period is 20 years or whatever, right? And then, as I said, our ability to control the operations is also often impacted by what some of the public partner is responsible to do. When we talk about maintenance dredging, for instance, if we are not, as a port, as a terminal, are not able to offer the draft that our customers, the shipping lines, actually expect from us, and that obligation is on the public partner, the concession agreement would basically need to be very strict about those obligations, and also remedies about if those obligations aren't fulfilled. Because as a private partner, we would then actually want to be able to step in order to create that draft that was basically promised from the outset. So then a second thing is clarity on our concession fee and rate structures. So on the rate structure, for instance, if there is a future change in the regulatory framework, that can happen, but we as a private operator would need to be protected against the situation that what we expected to make in terms of returns in the years to come may actually be impacted by a certain decision taken by the hosting government. Right? If they're imposing regulations that actually restrict the rates that we're able to charge, then the concession agreement would basically, ideally, provide predictability and transparency about it, but also consequences if that doesn't turn out to be the case. And then lastly, what I think is an important area when we talk about a takeover of operations by the private partner from a public partner is the labor situation and reforms, right? Because we as a private operator are basically being introduced into the port in order often to improve the operations. And your frontline workforce is a critical part to that. So how we staff and how we interact with the people working in the terminal is of critical importance to us actually bringing the value that we are expected to bring, and to us achieving the objectives that we have set for ourselves to achieve. And I think with labor reforms, it's obviously it's probably no surprise that sometimes in public setups, the staffing may be looked at differently than a private operator would see as an ideal. And if the public and private partner upfront realize and recognize that it is an issue that needs to be sort of dealt with, then it should be a joint effort, right? If you identify it as an issue that needs to be tackled, it needs to be tackled from the start, and basically in a true partnership. Because if basically the problem is being outsourced to the private operator coming in, that may very well lead to a difficult situation for the private operator to do the operations, and could impact on the public partner and the port as a whole due to future strikes, etc. So I think those are three areas that there are of course plenty, but at least those three areas I think are critical for us, and that is also what we have seen as important areas in some of the privatizations that we have gone through as APMT within Africa, but also in other parts of the globe. So I hope that provides some context.
Yes. Thank you very much, Sibe. I think what I'm hearing from everybody today is clarity. There has to be clarity of obligations. There has to be clarity of objectives. There has to be clarity on returns. There has to be clarity on who does what in order for this partnership to work. I'm going to go off script a little bit. We have some questions that are already coming in. And I would like to, I think this question can go to you, Sibe, and maybe Mark. I don't know if there is an answer. Every good lawyer would say it depends, but I'll read the two questions together. And the first one is, what's the accepted weighted average cost of capital in this industry, or what's the accepted IRR for investors in this industry? I don't know if it's possible to have one answer to this, but Mark and Sibe, what are your thoughts on this?
I definitely have some thoughts, but perhaps it's interesting for Mark as an independent sort of party and former World Bank executive to come to that, and then I'll provide the private sector perspective afterwards, if that's okay.
Spoken like a true lawyer, Sibe. Spoken like a true lawyer. Over to you, Mark.
Yes, well, I'm afraid I can't be that definitive on it. I mean, I clearly, there are different stages, there are different, I would say, layers in what we to come up with what is the internal rate of return, in particular for an investor. And I've not been involved live in negotiating concession over the last few years. I guess the overall cost of money having come down, it must have an impact. But what I can remember from a few years ago, when we were not in that very low interest period, is that typically we were a private investor would looking at a financial rate of return in the vicinity of 20% of its investment to go into such a long-term infrastructure expense, while the pure economic rate of return, typically an international financer will look at, was more in the vicinity of 10-12%, and it has come down a bit ever since, that I know. As a weighted average cost of capital, of course, that will really depend on how we bring the resources together, and that's where the international financial institution help typically lower this cost by providing longer maturity and some kind of guarantees as to the commitments also taken by the governments. I mean, the World Bank guarantees are developed in a very complex fashion over the last few years. So I will go into details, but when Sibe was referring to change of regulation, for instance, over the course of a contract, where those kind of guarantees can come into play in that case to compensate basically what impact it may have on the concession, and of course the financial amount involved will be transferred to the government in the form of a loan. So that is an incentive for government to behave basically when they have to live up to the terms of the concession. So as there is no direct clear answer on what's the level, I suppose a PMT must have a clear objective in how much it wants to achieve when it's looking at an investment. But the risk part of it is basically what will be added to the typical pure, I would say pure, let's say mere consideration of economic rate of return. You will have this risk, country risk, project risk, global risk that will be factored in that, and that's why in the past it would easily double basically the immediate economic rate of return an international finance and international development institution will look at. So I hope I suppose I've drowned the fish a lot, as we say in French. So now I leave you to sort it out.
Thank you, Mark. Sib, very quickly.
Thank you, Mark. It is indeed, as you say, it very much depends. But I think it's fair to say that since we are focusing on Africa, the returns that typically private operators are expecting from an investment in Africa, which is still often seen as higher risk than in some of the Western countries, or it's just a return expectation that is higher because of, as Mark was saying, the way it's built up. We have our standard cost of capital, which for every company is different, depends on how you're being financed. If some operators in the industry are basically state-backed, so their cost of capital is lower. There may be other strategic elements that play in for those investors, but for us as a private investor, we have our standard cost of capital, and then there is a certain country risk being added to that, and dependent on how the revenues are basically generated, whether that is in local currency, whether that is in US dollar or euro, there's an additional markup. So if you have sort of worst case, then you have your standard cost of capital is being increased by a risk factor on the country, and it may be increased by a further currency risk. And then you can indeed in African countries come to what Mark was saying in the range of 20%, whereas that in other countries would be more in the range of 10, 12, whatever it is. So it really depends on what the country is that you are investing in, because not every country in Africa does have the same risk profile. So that will be seen differently. And it depends on who the actual operator is pursuing it and what their relative cost of capital and appetite for risk is.
Excellent. Thank you very much, Sib. We see the questions coming in. Please keep them coming. We will ask them intermittently. I'll now move back to the public sector, Ahmed and Richard. There's a bit of hesitation, definitely not in your countries, but generally on the continent, to use the landlord port management model. Could you please expound on why there's a bit of hesitation to use this model in some countries? We'll start with you, Ahmed, and then we'll move on to Richard. Ahmed.
Thank you, Prima. Of course, it's very simple because port authorities used to manage the ports. So by giving up their authority, that means they give up everything. So, but it's in the best interest of any given country to separate the operation from the management. That is my conclusion. And I will never advise my government to manage ports by itself, but it's always better to have a private operator. Whether it is investing or not investing is another issue, but at least to have a private operator is a healthy relationship. It improves efficiency, but also it gives you authority to monitor, to help him accountable for his delay of investment or improper actions or any kind of malpractice. So still you have the authority. But what you don't have is the overall operation and management of the port, which is, in my view, is a win-win situation for both sides. It also takes from the port authority responsibility of any complaint of inefficiency, delays, poor investment or delay of investment or whatever. And it gives us the full authority to charge the operator if he doesn't meet its the agreed KPIs, or it misses milestones. All this gives you the authority. But those who used to manage ports themselves, or you still manage like port in Mombasa, it's always, they want to hold this position. But I don't think it's good in any way. So I will not advise my government to operate a port.
Thank you, Ahmed. So there is a perceived loss of control that has made many governments hold back. Richard, what are your thoughts on this?
Thank you, Ahmed. Just to add on what Ahmed has said, the hesitation comes more in, I would say, first, lack of knowledge as to the advantages of, let me say, having a private operator as an investor. Because, again, the other thing is not only the understanding, but if you look at other examples, again, if I come back to the case of the Port of Walfish Bay, what we did is that before we finally decided that we were going through this route of concessioning, we did our own benchmarks, where we looked at private investors or terminal operators around Africa and other parts of the world. And you would know the widely publicized issue in Djibouti. For example, we visited Djibouti last year. And that hesitation comes in where you would see some of the private operators usually using the back door to invest in African countries. And people normally would feel, because it's a public property, people, they would see this as somebody coming in, through the back door to make more money out of a public property. So that is basically where you see this hesitation. But there are better examples everywhere around the world. It's more a thing of education, educating the public sector to see the benefits that comes with these type of investments. And then as Sibe was saying, I was just thinking when he was talking that from the Namibian point of view, we're looking at this as a win-win situation where, the investment that is coming also helps us in a way, but the investor also equally gets something out of it. So if you look at it from that point of view, it helps parties to understand. And also, you know, the world is moving into a certain direction. And Ahmed put that one very perfectly, where he said that you can't be a referee and a player. You are either a regulator or an operator, so you can't be both. Like in our case at the moment, we doing operations, and we are all on the other side also doing, you know, the management of the authority part, the legal part, the governance part of things. So it's a balance of understanding what is it that you will gain out of going through a project like this. Thank you.
Thank you very much, gentlemen. I'll just stick on you for a little bit. I see Mr. Puyi from the Gambia has asked the impact where a government chooses to use the landlord model, but also chooses to be an equity shareholder in the port concession. So have you seen this, and what are your thoughts? This is to everybody. What have you seen this, and what would be the impact of sort of the government wanting to have its cake but also eat it a little bit? Yes,
I think,
go ahead.
I think
okay.
Yeah, from our side, there was another question, I think, before that, that was asked by Alina. Maybe if we can address that before we move to the next one. Because specifically she was asking about the investment, if there's investment in terms of infrastructure, access to the area and all that. In our case, again, the other thing that I would like to highlight is that, you know, we have sort of looked at the objectives of concessioning in the African context. But the other thing that is very important is that with the studies, the benchmarking and all those things, you need a perfect team. You need the perfect partners in terms of your negotiating team, in terms of the procurement team, you know, people that have had experience in this area. So that helps you to set your objectives right. It helps you also to know what you need to get out of the whole project. The other thing is that, going back to Alina's question, in terms of benchmarking, when we were doing benchmarking, we looked at countries like the UAE. What they've done in terms of building a terminal, you can't have a terminal without having access to the terminal. And one of the things that we did is that in the concessioning or the procurement process, part of the objectives that we wanted a clear business plan that would address somebody that needs to come into Namibia, look at not only transshipment, look at corridor cargo, look at gateway cargo. You needed to give us a comprehensive marketing plan, for example, that would tell us how do you get copper out of the DRC into the port of Walfish Bay, for example, if you want to develop corridor cargo. Not necessarily just relying on transshipment. Transshipment, we've seen the likes of Salala. They were closed for some time when the transshipment disappeared, a few cases around the world. So we wanted a comprehensive plan that spoke to the facility in order to increase the value of the facility. Again, from our side also, we had to be convincing in making sure that we have got a corridor that works. We've got roads, we've got airports near the terminal, again, going back to Alina's question, to make sure that the infrastructure around the facility that you are concessioning is supportive of a holistic logistics plan, you know. So that is from our angle what we looked at. We made sure that we've got enough roads. Somebody was saying that we've got the best roads in Namibia and the high rate of accidents. The only thing that we are currently also focusing on is making sure that the rail infrastructure also supports that. And some of you will know that we recently, we had a study that was commissioned by the Ministry of Transport, where we want to connect our rail line from the port of Walfish Bay into what we call the Ndola-Lubumbashi corridor, which is the most profitable trade corridor that we have at the moment. So you look at the whole infrastructure holistically, and also in appointing a partner, you need a partner that talks to, you know, a whole supply chain kind of model in terms of the investment.
Thank you, Richard. Maybe since we've taken a bit of a turn, we've addressed the infrastructure question. Maybe, I don't know if Ahmed, you have any thoughts on the infrastructure question, even as you are both operating a brownfield port, and what are the thoughts of the infrastructure for this if you were to have a greenfield port? After Ahmed, I'll come to you, Mark.
Yes, so sorry, no, I have an emergency. We just popped up, so I won't be able to stay. I'm sorry, I will have to run, that's why.
Apologies, Mark.
Okay, go,
Okay.
sorry.
Okay, Eric, we wish you all the best. Okay, thank you, Peter, and thanks for Richard for his explanation on that part of Africa. In terms of infrastructure, is very important. Without a road network or rail network, the ports itself is not profitable. And a classic example is Djibouti, a small country. Population is less than half of Namibia, and the size is very small even than Namibia. But still, they build a lot of ports with infrastructure for the road, railway, connecting with the big market in Ethiopia. Even they don't have other neighbors. I think main neighbor they have Ethiopia. So you can see if you have port and infrastructure, you can have a better, more business, more volume than only port alone. And in Somalia, Mogadishu, as we all know, the volume has been increasing year by year, year in, year out, almost 15 to 20%. But still, 90% of this are consumed within the capital, with around 3 million population. Because roads are blocked, we're not open, we're very poor condition, security was not good. And now that we are expecting government to take action and improve and open the roads and start building the roads, we are already in the planning stage of developing the first pre-feasibility study of a greenfield port. Because Mogadishu is within the city, and investing in the long term is not an option, neither for the port operator nor government of Somalia. So we are looking for an option. Berbera is another example in North Somalia, where DB World is investing over 400 million upfront. This is one of the best investment you can get anywhere in the world, where DB World has increased the capacity of the port, brought in all the necessary equipment, put terminal bridge system, and then build the road linking to the Ethiopian corridor from Hargeisa to Tegucigalpa. It's around 165. So sometimes you get a good operator, which can bring the investment needed upfront. Sometimes you have an operator which does not have money, in our case, where you have to struggle and find a way out. But in our case, it was simple. We just reduced, as you know, Prima, the contract from 20 years to 5, from 20 to 10 years, because now we have only 5 years contract with a very clear benchmarks to be met. Now we are discussing long-term plan, and we are also doing our own market sounding to see the market options of staying in this current port or going outside. All this now is on the table. But I think the best outcome of this concession agreement Somalia went through, first Mogadishu and then Berbera, is that the Somalis themselves has to wake up and say, look, if a foreign company can come in and invest in our ports and make money, why not us? And the first port has been built by local private businessmen in Garad, northeastern Somalia. It was opened last month, the first 2 pairs, and they are building the second 2 pairs within the next 2 years. And then now they are doing the feasibility study of the road connecting to Ethiopia. And this is purely financed local business. Of course, we provided them some support in terms of business plan and all that. But this port is now functional and 100% financed by the local people. And I can fairly say today that it will not be the first port in Somalia financed by the local business people. Others will follow very soon, because Somalia wants to become a want to improve its infrastructure, and people want to be part of that one. I think infrastructure is key. But one thing I think Djibouti did, which we have not done in other parts of Africa, is to combine the entire supply chain. Djibouti has one authority for road, ports, airports, everything is one under river railway, even airlines, transport for marine transport, all is under one authority. That's why Djibouti is making a lot of advance in infrastructure, because they have only one authority that's responsible for the entire supply chain. In Somali case, we have different authorities, and other parts of Africa, I think the same. So infrastructure is key for any port.
Thank you very much, Ahmed. Thank you very much. I think at this point, we'll take it back to the private sector. Please keep the questions coming. They're keeping us very engaged, but I'll take this back to the private sector, to Sibe. Unfortunately, Mark had an emergency and had to leave us. We hope all is well, but we will continue with the speakers that are online. So Sibe, what do you consider as the biggest benefits for the private sector getting involved in ongoing port operations? What do you bring to the table as the private sector?
Okay, let me be try to be modest, but
yes.
and
you bring
humble.
Everything. You bring the table.
No, I think well, I mean, the obvious thing is, and I mentioned it earlier, right? If we are able to bring what we believe we are good at, then we are actually bringing efficiency to the port. Then we bring innovation, which is sort of fueling efficiency. We bring access to operational skills and training to the entire local workforce, and all of that, sort of the combination of that, if a PPP is properly functioning, then that will basically be sort of a snowball, right? Because if we are improving the efficiency of the port, we are improving the competitiveness of the port. That will improve the competitiveness of the country. If the competitiveness of the country is increasing, then you are actually igniting more economic growth, etc. Right? So that is, of course, in an ideal world, what should be the result of this. But as I say, I think if we as a private operator have the ability to bring just that, that will be that will bring the most benefit for all, for both the private partner, but also for the public partner.
Excellent, thank you, Sibe. So you bring innovation, you bring efficiency, you bring training, and
money, right? I mean, it's investment, but it's also lease fees that we pay to the government. We pay taxes. We do, it's a lot, which is otherwise not coming as such from a publicly operated entity.
Correct. So Murataj has sent in a comment that a port is not an island, a building, and managing a port needs continued evaluation of all the factors, and it's never a cheap choice to run a port in any country. I would like to ask another question that was also earlier asked. And that really takes us, which is also one of the basic things that would cover again by Mr. Pui. And the question reads, in terms of port concessions, what is the most optimal form of concession, i.e. perimeter concession to different investors or the whole port to a single investor? Again, I would think it depends, but what are your thoughts in what is the most optimal form? Do you give everything or a little bit? Eric, please feel free to jump in as well with your thoughts on this. I'll let one of us volunteer. So what's the most optimal form?
Eric, are you coming? Okay. I think from our perspective, you know, it depends with what you want to concession. I think Sibe will tell you that. If you're concessioning a container terminal, for example, you would not want to have 3 or 10 operators, let me say 3 operators coming to your terminal. What we also realized is that as the public sector, is that there are a lot of things that you should watch out for. Because if you go for concessioning and you allow, and these were some of the ground rules that we set, where we said, for example, APMT as a company under MASC cannot bid for a concession for the same concession in Namibia together with MSC or with CMS CGM. You know, for you to get the best deal, you need all these entities to bid as single entities, not combined, because what we were advised from people with experience in this field is that you will get a raw deal if definitely if you were to combine, you know, 2 private operators to run a terminal, for example. But in other cases, as Ahmed was saying, you find that they I'll look at the example of Malaysia, for example. Malaysia have got a lot of these private. There's a mining company, corporate, that is now, you know, the terminal in Tanjung Palapas. They are partnering there, I think, with the CBM. They've got with APMT. They've got a certain shares in that investment. So you find these type of investors that are genuine, that can partner, let me say, with another private terminal operator, because you wouldn't want investors also to only be doing this for the money. Because what we have seen also is that other private investors that are not terminal operators would want to go into these deals for the money. So it's always up to you to evaluate your options and look at your circumstances to choose which option is the best for you.
I agree. Very well stated, Richard. Sibe or Ahmed, would you like to very quickly add to this?
Well, I think, I mean, I'm not sure if the question was also going a bit to the point of whether you award it to one investor or the whole port. If you're purely talking about one sort of specific type of cargo, then it depends on sort of the size of the market, right? But if we're talking about, you have a port, let's say a fairly small port, which is doing containers, which is doing a bit of bulk, and which is doing a bit of break bulk, then if you would want to concession that out separately, for each of those concessions, there basically needs to be merit to be done on standalone basis, right? It may be that the bulk cargo that is being done in the particular port is just too small to warrant a separate sort of concession setup, if you see what I mean. So I think again, it depends on what you are trying to solve for as the government, and what is the size of the market that you actually have available. And to Richard's points, I mean, if you talk about purely containers and the size is big enough, then there may be merit from a public perspective to have competition in the market. But at the same time, from a private operator perspective, if you are talking about a small port, then bringing in competition between 2 container terminals may not be the most attractive, right? So it's that balance that you basically need to strike in order to see what is the best solution for you as a port authority.
Excellent. Thank you very much, Sib, for responding to that. We're having a few more questions. I see we have just 15 minutes, so I will ask a few more questions from the participants. And Alina once again asks Ahmed and Richard, that you have regarding the selection of a private operator. Was this done via a competitive tender? Did you receive many bids? And what was the key evaluation criteria, if key selection criteria, if this is something that you can share?
Thanks.
Thank you, Alina. From the Port of Walfish Bay perspective, yes, we went through a competitive bid because, again, as I said earlier, and hence we were commenting on the issue of a station for Africa. You wouldn't want to have one operator only who doesn't go through a competitive bidding process, because you wouldn't know what you would be losing out. So what we did is that we first had an expression of interest where we had over 5 bidders that expressed interest. And from there, we saw that this was really a very good thing for us, because it was the 5 top terminal operators in the world. And then we took the same 5 operators that showed interest into a formal RFP process, a procurement process, and that is where we ended up with the one that we are currently negotiating with.
Thank you, Richard. Ahmed?
I think, sorry. Sorry.
No problem, Ahmed.
Yeah. I was having of course, it's always better to have one investor in such a small port. But if it's a greenfield port or bigger port, then it's always healthy to have different operators for competition purpose, but also for the purpose of the port authority getting more out of these agreements. So I think,
Ahmed, I think the question goes to the private operator that you're working with. Was it through a competitive process? Do you see advantage? Yes.
No. In our case, there was no competition, there was no tendering, there was no market sounding. At that time, there was no other alternative or option for the government. And this came through government to government support. Say, look, if you don't have one, then we can provide you one who is already on the ground. That time building hospitals, roads, and Turkish embassy. So they say, if you want to have, we can give you this company and you can enter into concession. So the government entered into concession without even due process. But then after I came to the port, we found that this concession agreement was nothing there for the government of Somalia. So that's why we have to renegotiate and then we have to hire consultants to do the study. We have to hire lawyers. We have to do all the background check of the company, and then we can come conclusion that the company was not in a position to finance the investment needed for the port. So we have to cut the remaining 15 years to 5 years, and then we have to reduce the share from the revenue to extract 52 million investment for the next 5 years. And then at the same time, we give them an option. If you want to have a long-term plan, then you can come up with a plan in 18 months. And then if we agree the plan, then you have to come up with an investor that can finance this 400 million, 200 million investment for the long term, which still we are waiting to get one. But for us to make sure that the port can function, we have agreed 52 million investment, which we deduct from their share. And now it has been invested, half of the money to the port, mainly equipment, but also now infrastructure has started. Terminal operating system will be put in place. There's a lot of training. And in these 5 years, we have the government of Somalia have now the option to get out of this contract if they cannot bring a good plan for the long term, and if they cannot find an investor. So we have now all opportunities to get out of this contract, because if we cannot agree by July next year, the contract will expire year 5. Even if you agree year 5, and then they cannot bring the investor in 15 months, still the contract will expire year 5. So we are now in this limbo, but at least this 5 months, we have enough money to maintain the port, to improve the services, to buy the equipment, to do the dredging, to build new terminal offices. And already we have all the equipment, cranes, tugboats. All this has been recruited through international tendering. And we hired 2 German consulting companies, HPC and Sub-Saharan, to help us to make sure that all the investment are done according to the international standard. And we are also hiring a new team, as you know, Prima. After the concession was signed, thanks to LSF, we trained our team how to implement the concession agreement. We have produced, as you know, with our lawyers, matrix for the contract, action plan, strategy plan. So from the government perspective, we know where we are heading now. And at the same time, we also hired other consultants, to undertake a brief study for the Greenfield port. So we are now on 2 tracks. On one track, they have the opportunity to come up with a concession agreement, a long-term plan. At the same time, Somali government is doing its own and financing by itself brief study for the Greenfield port, where the local investors are now saying, look, we want to put money ourselves. As the local banks and local businesses say, look, since why you are bringing in all these other companies, we can also finance if government can hire a proper port management company. So still they want, even the private sector want to have a management company that can manage, or a management and investor that they can join the investment. So we have these 2 options now. Both options are on the table. The operator has the first priority to come up a long-term plan and get a financier. If not, Somali government will step in and then continue with another operator, and then also look financing for the Greenfield port.
Thank you very much, Ahmed. I think from Ahmed and Richard, we're hearing that competitive bidding is always the best, and there are ways to undo the downside for not bidding competitively. I'll now move back to Mark. And for Mark, I would like you to address the difference between a greenfield project and a brownfield project. When it comes to concessioning out port management, what are the differences when you choose to go greenfield and when you choose to go brownfield? What key decisions are being made? What is the difference in the sort of operators? What's the difference in what the government is looking for? How do the 2 transactions differ?
First, sorry for this interruption. I addressed a scare with my daughter. She's 25, but she's scary from time to time. So sorry, it's more fear than harm finally. So anyway, I'm back. Anyway, so yeah, greenfield or not greenfield? Well, the main difference is that if you consider a greenfield investment, you are creating a new situation, basically. So when you are operating in a port and you are building a new terminal or concessioning an existing one, you are dealing with a well set of facts. You know what traffic you have that so far. You can more easily draw perspective, forecasts. As Richard mentioned, you can even think about, if I improve my facility, will I be able to catch on transshipment, and then will that help actually bring together more resources? Well, we are decided on a green field. Obviously it's new, so you have a couple of cases. Basically, is it a greenfield to complement what you already have, or is it a greenfield port to replace the old one? That because ports can be trapped in cities. In most cases, actually, historically, ports are being developed within the city environment, and it may become just too complicated and costly to expand the port from this historical base, and then you may have considered building a new one. And that will be a greenfield operation, but still a greenfield operation which is expected to basically get all the traffic which used to go to the previous one. When you build a greenfield port in addition to existing ones, that could be an industrial port, could be a bulk port, could be a big general cargo port. And in Africa, there have been several cases considered, at least, of those developments, and a few have taken place. Then it's a more challenging venture, because then you have to get some strong data that this indeed will answer some market needs. There are cases too when investors, private investors, will approach government with an unsolicited proposal, as we say, to precisely tell, hey, we believe it's a really good idea to build a port there. I'm ready to build it for you against a concession, against such agreements. And it's always worthwhile looking at those things, but very, very, very carefully. Indeed, if it happened that the economic case around this greenfield seems worthwhile considering, the government would always be better off to try to generate some competition to this unsolicited proposal. Then there is a classical way of doing that all of us know, which is a Swiss challenge, basically, whereby you'll use this original proposal, offer the possibility for others to submit, and offer again to the original proposal, basically, to align itself if indeed a newcomer provides a better deal on the same terms. So greenfield, you need more information to be sure that the market will be interested, and that's where the market sounding, the forecasting has to be extremely thorough. In most cases, you still will have to distribute the investment between the private and the public sector, unless you're operated in a pure sheltered area, access is already there, just have to build the berth and operate it. It's rare those days, but that may happen, in which case, okay, it's a greenfield, but it's just something that a private investor may possibly consider if the institutional legal framework, contractual arrangement we discussed before are right. If not, and I have in mind a couple of those greenfield projects, it will require typically the government to provide the access, to provide the protection, to provide the depth, and then offer that to the private sector. The rest will basically be the same. I'm sorry I missed some of the exchanges and the discussion, but when I left, we were talking about also the objectives, the performance. Sibe mentioned what a private sector operator is expecting. What I've noticed in being involved in a number of those discussions is that often the government has a bit of unreasonable expectations. They both want to sometimes have their cake and eat it, basically, and in part because of the reasons Ahmed mentions. Concessioning the single port or the single terminal in the country, politically, sometimes it's difficult. People are thinking that the government is basically giving away the crown jewel, so to speak. And so they are pushed to try to show that we'll get something in return, something beyond sometimes the reasonable. The reasonable is to expect what the private sector can deliver. In a management contract, which is a kind of toned down contractual arrangement, it's an obligation of means. You want the private sector to give you some means to operate, you pay him for that. In a concession, it's more or less, it's more an obligation of results. You are bringing somebody, you expect him to deliver, but what kind of results? You want productivity, you want efficiency. Sometimes governments say, but this guy will bring us more traffic. And that's a big red line for me. I believe it's wrong to ask a concessionaire to commit to bring more traffic. Most of the time, even when it is linked to a shipping line, and Sibe will know that, of course, the subsidiary operates independently. The APMT will not be able to bring more traffic by Maersk. And that would be wrong that it happened, because it would give a sense to the other user that there is a kind of skewed behavior there toward the other users. So it's wrong to ask for additional traffic, but many times I've seen that government wants to basically appease the concern of the public by saying, look, guys, we're getting more from that. You'll get more from a concession if it's well designed, so that the private sector, on top of the investment he will put it, will have the incentive to deliver more. And the government will be able to show that the cost of going through the port have come down. So imports, in all likelihood, will be cheaper. Export will be more competitive, and that's where the benefits lie. But that's kind of economic concept. Sometimes governments have to educate, indeed, the population as to what is happening, to not just fall into the trap of saying, we just ask the concessionaire to give us more. Because what happened in that case, even if the concessionaire has to somehow agree to a traffic commitment. In fact, the traffic commitment will translate into a revenue guarantee. That's what it works. Typically, a concessioning authority will tell you, if you don't give me this level of traffic, you'll be penalized. So it's a revenue guarantee that goes into the risk section. The concessionaire will price up whatever it needs to, whatever it needs to get from the concession, and all that will make it much less profitable for the country as a whole. So I believe it was important to keep that in mind. And when you look looking at a greenfield port, well, it's all the more important not to put those kind of expectations saying, I'll bring a private operator, it will bring the traffic. No, the traffic will come provided the conditions are ripe. Sorry, I've been a bit long, but I hope I didn't repeat things you already heard. Thank you.
No, that's absolutely fine, Mark. I see we have run out of time, unfortunately, and there are still questions. We are going to have closing remarks from all the panelists before Eric fully closes. I know that Jesse has asked about lessons learned from COVID-19. William has asked about critical factors for success of financing on the African market. And there are also questions from Clement about mitigations to insulate the port concession projects. Unfortunately, we are not able to address all this, but even as we close, I would ask you if there's a sentence or two that you can say about any of the questions that has been asked. Please go ahead. We will start with you, Sibe, Richard, Ahmed, and we will finally end with Mark before Eric gives us just a conclusion of what has been discussed. Over to you, Sibe.
Okay. Thank you very much. Interesting discussion indeed. Let me take the opportunity just to address the last question that came in from Clément. Mitigations to insulate a port concession from political and legal risks. Legal risks through a change of law regime in the concession agreement, which basically provides a trigger where the economics of the concession may be adjusted. So there's an automatic adjustment of the lease fees or something in that kind. Political risk is a bit more difficult. This also depends on what the definition of your political risk is. But the country risk that is applicable to a certain country involves that political risk. And that is then automatically translated in the country risk that you apply as a discount rate to your investment. So the higher the political risk in a country, the higher your discount rate. So automatically that means that you, as a private investor, are expecting higher returns, and you basically build in part of that political risk in the financial assessment of the project. And then there is of course force majeure, dependent on whatever your definition of that is. So thank you for attending, and hope to see you in the next seminar.
Thank you, Sibe. Richard?
Thank you, Prima. Thank you all the people that are attending. This was a very special one, our first, I think, for Africa. And thank you for the contributions once again. On COVID and concessioning, not much that one can say there because we started the process at the end of concessioning, almost at the end of COVID. I don't know whether COVID is now gone forever, but yeah, there weren't many lessons really that we could learn through COVID regarding to concessioning. There was one point that we missed out on, Alina, in terms of the criteria that one has to look at. There are a few things that are critical. For example, for our project, we looked at there was a set NPV value that we wanted out of whatever financial proposal that we could get. Business plan, very critical. Things like labor, as Sibe was saying earlier, there is a compromise, especially if you are from the public sector and concessioning a port facility. You should strike that balance between what the concessionaire, because remember, you are not only concessioning, this is an investment for you as a country, this is an investment for you as a port authority. So the criteria that you set should be trade friendly, if I can put it that way, to make sure that whoever is coming to invest thrives in making or in getting more value for both you and the investor out of the investment. Thank you very much once again.
Thank you very much, Richard, and thank you for those lessons learned from NAMPORT. Mark, over to you.
Yes, at this point, and I answered on the chat a question about renegotiation when I mentioned a number of concessions were being renegotiated. I didn't mean that they were renegotiated as part of the overall contractual period, but just because the first batch of concessions having been awarded in the 90s just came to their end, contractual end, and have been renegotiated or are being renegotiated just because there were extension proposals to carry on. And it's always if the concessionaire had behaved in a satisfactory way, most contracts will offer the possibility for the concessioning authority to agree on negotiating an extension. Now, what does all that means is that overall, I believe the concessioning process have proved to be very beneficial to countries in improving the capacity of their ports to handle the traffic, in bringing down the prices, the cost of going through the port, and they're improving the overall country competitiveness, to put it in a broad economic formula. But that will happen only to the extent that the concessions are well balanced, that the checks and balances are there, the controls are there, legitimate control from the governments to make sure that the concessionaire behaves according to its commitments, and it makes the most of the existing assets which have been provided to him, or the assets that he has built but will come back to the government, but not exaggerate control, because the concessionaire, as CB mentioned, has a legitimate concern that he should be able to deploy its operation without being impeded by unreasonable requests. So that's a kind of balance. When the balance is here, I believe the jury clearly comes out saying that there are benefits to be gained, both in mobilizing resources, in improving productivity, and then bringing down the cost of the supply chain going in and out of the country, which indeed should be the overall objective of concessioning ports. Thank you.
Thank you very much, Mark. Ahmed, any final words?
Thank you very much. First of all, and I thank Prima. The conversation of the team was very interesting from all aspects of this panel. I think what's important is in any concession agreement, we have to protect both sides, not only one side. I think the protection of the investor is important, because then you can get a good investor, but you have to protect his interest also. On the other hand, the institutions also, they must protect themselves. And concession agreement is a living document. You can review all the time. You can always discuss. You can always have a review whenever you want it, based on a good reason why you want to review the contract. It has to be agreed with both sides. There has to be clear obligation on both sides. I think protection of both sides is important. On the issue of COVID-19, even though COVID impact in Somalia was very limited, still we felt the import we felt, and the revenue went down. Still we have to recover to the level of 2019, because most of the trade, our main trade partner was China, and China's zero COVID policy has impacted, but also the price has played a role. But at the same time, Somalis also took advantage. They have to go to find new markets. So Turkey, India, Middle East, they have to find a new market where they can get the goods. I think we expect 2022 to reach or recover the pre-COVID-19 level. And then from next year on, I hope the port will still increase in terms of revenue. Volume still is good, not bad, but still we are below 2019. Thank you, everyone.
Thank you, Ahmed. Eric, please help us close this off, and we'll let the attendees go.
Yeah, thank you, Prima. I'll do it very short, as we're running out over time. But thanks for all the panelists for an excellent open discussion, and for all the attendees as well, of course. I hope everybody got a better idea of what these port management models, what the difference between them, and some of the challenges when we transition from a service port model to a landlord port model, like labor, like investment, like risk, and so forth. As to the open question, we'll be happy to come back on these, and in case there are sort of, if you have further questions, I'll be happy to reply to them, and feel free to reach out to either Prima or myself, or on these, and we will come back to you. And also in case there are other topics, other related topics, we'll also would like to hear from attendees on these for our program for next year. Thank you, and back to you, Prima.
Thank you, everyone. Thank you for joining us, and have a good rest of the day. Bye-bye.
Thank you very much. Right.
Thank you. Bye-bye.
Bye-bye.
Thank you. Bye.